Imagine for a moment that you've done everything right. You've spent the better part of 2 decades building equity, navigating the volatility of the 2008 crash, and surviving the post-pandemic rate hikes. You've found the perfect exit, a multi-million-dollar property sale that represents your transition into a more liquid retirement. The contracts are signed. The boxes are packed. The movers are scheduled. Then, on the morning of the closing, you receive a short, cryptic email from your escrow officer. The system is down. Not just their email, but the entire infrastructure required to verify the wire transfer and record the deed. You check the news expecting a market crash, but the Dow is up. You look for a local disaster, but the sun is shining. The value of your home hasn't moved a cent, yet your $2 million in equity is suddenly as inaccessible as if it were locked in a safe at the bottom of the Atlantic. This is the new reality of real estate, the frozen closing. It is a scenario where your wealth remains intact on paper, but becomes functionally non-existent due to a server error message. We have entered an era where the liquidity of your most significant asset is no longer determined by the market, but by the uptime of a handful of centralized tech vendors. I am the horizon, and today, we look beyond the headlines to analyze why the plumbing of our property markets has become our greatest systemic risk. A recent Bloomberg report has confirmed what many in the institutional space have feared for years. The FBI and several major banking institutions are currently assessing a significant hack of a critical real estate finance tech vendor. While the headlines focus on the breach, the theft of data, the sober reality is far more concerning for the mature investor. This isn't just about your social security number being on the dark web. It's about the interruption of the settlement stack. When the FBI gets involved in a tech vendor breach, it signals that the intrusion has moved beyond simple identity theft and into the realm of national economic security. Bloomberg notes that banks are now scrambling to determine the blast radius of this event. In the world of finance, we call this concentration risk. For years, the real estate industry has prioritized efficiency over resilience, migrating its entire workflow, from title searches to escrow disbursements, onto a few centralized platforms. These platforms have become the plumbing of the industry. The Bloomberg brief highlights a fundamental truth. The complexity of modern real estate finance has created a single point of failure. If the vendor goes dark, the transaction stops. The FBI's presence is a tacit admission that the plumbing is not just broken. It is under siege. As an investor, you must understand that the scale of this intrusion isn't measured in the number of files stolen, but in the number of days the market's exit doors remain jammed shut. For the generation of men over 40, our concept of ownership was forged in a different era. We grew up with the understanding that a deed in a safe or a physical signature at a mahogany table represented the ultimate security. We viewed real estate as the hard asset, the bedrock of a portfolio that could weather any digital storm. However, we must now confront a difficult intellectual honesty. The digital layer has become the gatekeeper to the physical asset. We have mistaken ownership for access. You may own the title, you may own the equity, and you may hold the keys, but in the modern economy, you do not have liquidity unless a proprietary software stack says you do. This is the illusion of liquidity. Because real estate transactions now require instantaneous digital verification across multiple third-party vendors, your ability to liquidate your asset is entirely dependent on a tech stack you likely didn't even know existed. This creates a paradox. While the property itself is tangible and safe, the process of moving it has become ephemeral and fragile. We have traded the slow, manual reliability of the past for a fast, digital efficiency that lacks a manual override. For the mature investor, recognizing this shift is the first step in institutional-grade risk management. You are no longer just managing market risk, you are managing access risk. To understand the importance of code in ensuring the integrity of retirement vehicles, we need to examine the foundations of technical verification. Technical verification refers to the process of using software and algorithms to verify the accuracy and reliability of data. In the context of automated ledgers, technical verification is critical because it enables multiple parties to trust the integrity of the ledger without relying on intermediaries. This is achieved through a range of techniques, including cryptographic hash functions, digital signatures, and zero-knowledge proofs. As we'll see, the role of code in technical verification is multifaceted, and its implications for retirement planning are profound. As we conclude this first part of our analysis, I want you to consider the weight of your own records. We have been conditioned to believe that the system is a monolith, that it is too big or too regulated to fail at the foundational level of property rights. The Bloomberg report is a crack in that facade. It is a reminder that the digital infrastructure of our world is surprisingly thin. If you are a high-net-worth individual, the strategy of set it and forget it regarding your real estate holdings is officially obsolete. In Part B, we will analyze why traditional title insurance may offer a false sense of security in this new landscape, and we will outline the Horizon strategy. The practical, sober steps you can take to move from passive ownership to active forensic verification. The goal is not to provoke fear, but to foster a level of intellectual honesty that matches the complexity of the times we live in. Your equity deserves more than a digital promise. It deserves a forensic certainty. To understand why the Bloomberg report concerning the FBI's investigation into finance tech vendors is so critical, we must first define the concentration risk event. For decades, the narrative of the free market in real estate suggested a decentralized landscape of millions of homes and thousands of independent brokers. But beneath that surface, the plumbing has undergone a radical consolidation. We have moved from a world of paper ledgers and local county clerks to a highly centralized digital architecture. Today, a handful of tech vendors, the very ones currently under the microscope of federal investigators, act as the sole conduits for title insurance, escrow management, and wire transfers. When we speak of a kill switch for the U.S. housing market, this is not hyperbole. If these 3 or 4 major vendors experience a sustained outage or a sophisticated breach, the ability to transfer ownership simply ceases to exist. As an investor, you may own the asset, but your ability to realize its value is entirely dependent on a digital stack you likely didn't even know existed until it broke. This is the definition of a single point of failure, an entire asset class held hostage by the security protocols of a mid-sized software firm. As mature investors, we are conditioned to fear market volatility. We watch the Federal Reserve. We calculate the impact of a 50 basis point rate hike on our cap rates. But there is a sober reality we must confront. Market volatility is a pricing problem, while operational paralysis is a survival problem. A rate hike might shave 5% off your exit price, which is manageable within a long-term strategy. However, the settlement shutdown we are analyzing represents a total loss of liquidity. If you are in a 1031 exchange, or if you are leveraging home equity to fund a separate venture, a 14-day delay due to server issues or an FBI-mandated forensic audit isn't just an inconvenience. It's a catastrophic breach of contract. In the Bloomberg report, we see banks and federal agents assessing the fallout. This isn't about the price of the home. It's about the functioning of the mechanism. For the man over 40, time is often more valuable than a few percentage points of margin. A market dip can be waited out. A frozen settlement system, however, destroys the one thing we cannot recover: the timing of our exit. We must begin to weight operational risk as heavily as we do interest rate risk in our portfolio assessments. How are the giants responding? The Bloomberg report notes that major banks are actively assessing the damage. This institutional response provides a roadmap for us as private investors. When banks see a settlement risk event, they don't just fix the software. They change their defensive posture. They are currently stress testing their settlement risk, modeling scenarios where their mortgage pipelines are frozen for 30, 60, or 90 days. For the private investor, this means the era of seamless, push-button real estate is likely over for the foreseeable future. Expect more friction. Expect banks to require larger cash reserves and longer closing windows as a buffer against tech-driven delays. When the institutional players move into a defensive crouch, it serves as a signal. They are acknowledging that the digital plumbing is no longer a given. They are pricing in the risk that the vendor they rely on for title clearing might be offline tomorrow. If the banks are worried about the settlement bottleneck, we, as informed peers, must mirror that caution. We must stop viewing our property as good as cash, and start viewing it as an asset locked in a vault where the key is held by an increasingly vulnerable third party. So, where does this leave us? At the horizon, we do not react with panic, but with adjustment. The plumbing risk is now a permanent feature of the digital economy. To maintain long-term sustainability, we must reevaluate our portfolios not just for where the assets are located, but for how they are settled. This involves diversifying your settlement exposure. It means asking your title companies and lenders about their tech stack redundancy before you sign. It means maintaining a liquidity buffer that doesn't rely on a just-in-time closing. But more importantly, it requires an intellectual shift. We must move away from the guru promise of effortless wealth and toward the sober reality of institutional-grade risk management. The hack reported by Bloomberg is a warning shot. It tells us that the bridge between finance and technology is still being built, and it is currently fragile. Your home equity is your legacy, your retirement, and your hard-earned stability. Do not let its safety be a blind spot. Stay analytical, stay informed, and above all, stay calm. The horizon is shifting, and our goal is to ensure your position remains secure as we move toward it. I'm the Horizon. Thank you for your time.